But let's get a little bit more in terms of what's going on in the market as we have about an hour to go until the closing bells. And I'm curious in terms of whether or not we'll get a little bit of a pickup into those closing bells. We'll see. Certainly a lot at stake here. For more, we're joined from the TSX by Dana Avigdor. She's a portfolio manager and head of trading at Barometer Capital Management. Dana, great to see you. Thanks so much for joining us.
My pleasure.
You know, when I saw the markets this morning, I thought, I don't know how it's going to act into the closing bells in the sense that, does anybody really want to put risk on into the weekend? There's still so many trade headlines that we've got to be mindful of. What do you think?
I feel that the last 2-3 trading days have kind of come full circle, a circle that kind of started fourth quarter of 2018. We had that massive sell-off, and we went from a narrative of full growth and rate hikes and everything is great, earnings growth, extreme bullishness, and over the course of something like 60-65 days, we went to the other extreme, full sell-off. Do you remember? Massive up until December 26 was the first day that we kind of started coming out, relentless selling into the fourth quarter, and we went into a narrative of massive recession and bad economic data, and everything went from excellent to absolutely not excellent. The truth is always somewhere in the middle, and as some of the selling pressure and the quantitative selling that kind of follows a trend, which is lots of money that is managed that way. Once that dissipated, it allowed for a normalization, and now we've had a fantastic January, up almost 10%, an earnings season where the bar has been set really low, that has not materialized to the negativity that was being priced in. So we are gone into a very light volume couple of days, and we have things that we have no control of that are still in the horizon. I think the road ahead is filled with possible potholes that have to do with policy errors, policy mistakes, and political jawboning. So in terms of the macro and the long term, if I was to take out a couple of those narratives, the potholes that I'm talking about, earnings have been okay. Economic growth, we feel 2 steps forward, 1 step back, even if we're kind of slowing temporarily here. But we do have the trade wars, not the trade wars, but the trade worries. And we do have a Fed that it's a little indecisive.
Do you think it's indecisive? It seems as though it's got the markets back. And if anything, that's one of the unknowns that we can actually put to the sideline. Why do you think it's almost still flip-flopping a little bit?
I totally understand your question. It is what we wanted to see from Fed Chair Powell. The admittance or the agreement with the market that the economy is not red hot, that the economic data is not so great, but we wanted it. We wanted it before when it was the meeting when he last raised rates, not some weeks later that it feels that that he succumbed to some kind of market and political pressure. Economic data, remember.
But Dana, what does that mean though? When you're talking about the Fed as it relates to maybe a bit flip-flopping, what does that mean then in terms of investing one's money? I mean, I'm looking at it as though they're going to have the markets back, and as we know, you don't want to fight the Fed.
Yeah, you're right. They don't have to have the markets back. Their mandate is to fight inflation and to manage monetary policy. Now, I'm not saying that raising rates is what we need right here, but remember that the change in narrative happened during government shutdown. There was no economic data to see, and we're just kind of catching up now. So I totally agree with a data-dependent Fed is as it should be. That is the mandate. But you know, what happens if you have 5 pieces of data that are more positive? Mm-hmm. Will we go back into a very hawkish narrative?
Right.
Or are we? And at the same time, there is a normalization of the balance sheet. So at the time, it was the timing with which this happened, and the kind of extreme. I don't like extreme moves, just like markets. You know, that extreme move in October, November, not October, but November, December was abnormal. If you take that out, the markets really would have been just down about 6-7%, and that's okay if we take the sell-off
Sure.
and the rally. So everything, you know, with the speed with which information flows and the amount of data and hypersensitivity and the sound bites and the headlines, and maybe it's President Trump, you know, headlines and tweets that are coming up that, you know, that gives us this kind of hypersensitivity to everything and these extremes.
So, but Dana, what do you do
outside of
right?
that.
So, what do you do then from a portfolio management perspective right now? Because it certainly you sound frustrated with the markets and all the different players that can kind of really move these markets, and I think so do our viewers.
Yeah,
so you have to sit back and have a
opportunity.
strategy. So what? Yeah, there is opportunity. Where are the opportunities right now? Do you think?
Yeah, you're absolutely right. So not to be frustrated. What you need to do to not be so frustrated is to move away from the noise and decide with what portion of the money are you going to be tactical and with what portion of your money are you going to stay the course. I feel that people's time horizons have gotten to be really short. And with the increased volatility and the amount of information out there, with the speed with which it's digested, it gets really difficult to being able to trade everything unless you are like me, a trader, and you sit and you watch all the time. So I think that if you have the risk tolerance and the room in your portfolio and the capacity, or give it to an asset manager that has a capacity to trade around positions over the short term. But you do have to be able to look beyond that and have a longer term view. Like I said, from our perspective, economic growth is 2 steps forward, 1 step back, so going to the right direction. Earnings are still okay, it's been evidenced lately. So we have a barbell type of portfolio. So for example, our Canadian weights are things like REITs, financials, and some energy. And over in the US, we have information technology, software. So here you have your defensives, and here you have your growth, and you can kind of weigh the two according to the amount of risk that you feel the market can take. So right now we're sitting at a place where there are a couple of major market moving catalysts coming up. One is the US-China talks, and we have to see whether the government shuts down again.
Absolutely.
Right?
Yeah, and I think, you know, investors are clearly waiting and watching for that, and of course the potential China-U.S. trade talks as well. But with respect to putting the money to work and using a bit of a barbell approach, which has been your approach now, I feel like, for a number of years, which is probably the right way. I mean, you've definitely had risk on as well, but I think that you and your team have been very well aware of all these different risks out there. And that seems the case.
Yeah, we have been very fully invested last year, and mostly in the U.S., and a lot of technology, and a lot less Canada. And you remember we're not as positive on Canada and on the commodity trade as we were on the U.S. We felt that U.S. was much, much better. And then, you know, during the fourth quarter and a sell-off, we have these levels where we get pushed out of stock, so we did, and in some cases got us out. Almost some portfolios were 30% cash, and then in the beginning of January, the REITs kind of started showing up in our models, and so our asset mix between the two North American markets, Canada and the U.S., is more tilted than it used to be towards Canada, but still not a majority, if you know what I mean. So we feel that if we believe in regrowth and reflation, despite the fact that we may be going through a slowing patch, if we feel that we are reflating over time, then, you know, the commodity complex will probably do very well. And we've seen some interest in the energy names in Canada. And of course, you know, the REITs have acted very, very well. You know, if you're a business and you're looking for commercial real estate to rent, it's almost impossible to find it. And when you do, it's really expensive.
Okay.
If you're
So it's
looking
still
for
the area.
rentals, right? So,
Okay.
you know, and rates are where they are, and the Canadian dollar is holding. So it's on the margin better. We're still overweight US just because it's a bigger market and you have other sectors that Canada doesn't have. But yeah, so
Okay.
we're now fully invested, but we're not as beta or as volatile or as overweight as we could be. There's
Okay.
still room to go.
All right, Dinah, we got to leave it there. Great to see you. Thank
My
you very
pleasure.
much.
Thank you.
Thank you.